I have with me Vetri Subramaniam, Group President and Head of Equity at UTI AMC Limited. Vetri, fantastic to have you back and thank you for joining us. Before we talk about sector themes and your favorite books, let's first start with your take on the market.
Yeah, thanks Nikunj. Thanks for having me here today and the rest of my team as well during the course of the day. Well, I think the markets are doing what they do, which is keep everybody in a little bit of suspense about future course of direction. I think the story of India over the last 2-3 years has been extremely supportive macro fiscal parameters, all economic parameters actually, and you've also seen significant sort of flows from domestic investors into the market. There's been a series of policy initiatives by the government to sort of enable the country to achieve what we believe is our potential rates of growth, which are certainly much higher than what we are currently achieving. But we haven't yet sort of got to the point where we are seeing all of this come together in terms of achieving that higher growth rate. So that remains a bit of a challenge. And secondly, what we must be cognizant of is that a significant part of the movement in the market over the last 3 to 4 years reflects in part a PE re-rating of the market or a valuation re-rating of the market. You can choose whichever metric you want, but very markedly it is a valuation re-rating of the market. The contribution of earnings during the last 3 to 4 years to the actual gains in the marketplace are actually quite small. Depending on how you calculate it, earnings have contributed between a quarter and a third of the entire price gain that we've recorded over the last 4 years. So, with that in mind, I think we need to be a little bit cautious given where valuations are. The macro backdrop is conducive, and I think if you're willing to look out over an extended period of time, Indian investors do need to raise their allocations to equity, and that's something that will underpin the market. But I think from a valuation perspective, this is a challenge for somebody who's looking for value.
Hi, morning. Since you're the AMC of the month, let's talk about some of the fund performances. And, as I see your opportunities fund, your one-year return has been 14.7%. In the last 5 years, you've given a return of about nearly 13.5%. Since we're already at the fag end of 2017, do you think come 2018, and looking at all the market dynamics, both internals as well as global, would you say that maintaining this one-year return average of 14.7 is going to be a challenge? And will the market return be a more sedate one in the next year?
That's virtually impossible to say when you're talking about equities, which are a variable return product, significantly affected not just by fundamentals but also by investor behavior. So equities, to make a long story short, are not like fixed deposits whereby on an annual basis you can sort of clock in a steady level of returns. If anything, my concern at this point of time would be that the Indian market, as well as most global equity markets, have actually enjoyed a period of suppressed volatility, extremely low volatility, and this is rather unusual for the asset class. Not just if you look over a 25-year period, but even over the last 5 or 6 years, there's been a dramatic compression of volatility. So my concern would be that at some point down the road, there could be a little bit of a spike up in volatility, and hopefully investors are well prepared for that, and their investment plans and their allocations reflect the ability to navigate a slight uptick in volatility. But one thing I can tell you for sure, equity markets don't work like a fixed deposit in terms of clockwork, in terms of returns.
But Vetri, looking at the market dynamics, do you think a big bang move is due first and then a sharpish correction, or it's difficult to say that?
It's impossible to say that, and honestly I don't even spend too much of my mind share thinking about such issues, because it's not really what helps us create alpha for our investors. I mean, alpha for our investors is going to come from positioning ourselves in the stocks where we believe there are opportunities. It's going to come from creating an alpha relative to what the benchmark does, not by trying to second guess market movements. So if I think about UTI AMC or our investment process or the way we go about trying to create portfolios, the question that you described is not even a parameter in how we go about actually creating our portfolios. So, as an institutional asset manager trying to help investors achieve their financial goals, hopefully over 10 years, 15 years, 20 years, the factors that you're describing are not something which really get reflected in our portfolio strategies.
Be the return expectations from mid-cap funds now? Mid-cap funds have given 20%, some funds have given even 30% plus CAGR returns for next 3 years. What should one expect for next 2-3 years now?
Yeah, that's a great question, and I certainly, if you look at the data, it's quite interesting. If you actually look at a 3-year return of the Nifty, it's rather subdued. I don't know how many people realize that it's actually just about a 7% CAGR over a 3-year period. And in fact, even bonds have outperformed the Nifty over a 3-year period. But then you suddenly shift the perspective and you look at mid caps, and you find that the 3-year return on the mid caps is running, north of 20-24%. So it's been a dramatic outperformance by mid caps of, large cap equities. When we look at the valuations, what we find, and this has been true now for some time, not just of today, the mid caps have actually traded up to a premium to the large caps. And they've not just sustained the premium, they've actually in some senses also expanded the premium. I'm not sure to what extent those factors are permanent, and I think what we will discover is that just like everything else in the markets, some part of this is really more cyclical, and therefore if anything I would be a little bit concerned that in terms of a mean reversion of valuations, the risk is slightly more accentuated in mid caps as compared to large caps. Obviously we are talking generic asset class one versus the other, not a specific comment on individual stocks. But therefore, as a portfolio manager, if I had the option where I could sort of balance my portfolio between large caps and mid caps, our preference would be to sort of look more at the large cap space, simply because there are some more pockets of opportunities there as compared to mid caps, where the valuations have really been picked up. And I think the cyclicality of that is not something that people are really fully prepared for.
Vetri, most of the mutual funds currently are extremely gung-ho about financials, whether it is NBFC, private banks, and now insurance. And again, I'm just trying to simply, connect thoughts of Peter Bernstein, because I just realized that, you like reading that book. Mean reversion is the biggest truism. So are we in for some flat kind of returns for financials, and do you worry about this overweight positionings in NBFCs and financials?
Yeah, that's a great question. Keep in mind, however, Nikunj, that when you look at the financials exposure, not just at UTI or of the entire mutual fund industry, or for that matter, if you look at the institutional portfolios, right, of Indian institutions, foreign institutions, you will find a financial sector dominance over there. And the simple reason for that today is that financials are almost 30-33% of the benchmark, and therefore, very naturally, it automatically ends up attracting a disproportionate part of the flows, because most investors do at some point of time either have a very clearly articulated benchmark relative positioning, or they're at least benchmark aware. So there is an extent to which you would position yourself differently, but how different becomes a challenge when you're talking about a single sector being 32% of your benchmark. So certainly all of us have large exposures there. I think the one secular trend that we are seeing in financials in India is the rise of credit provisions to the individuals and to retail. If you look at the share of retail credit as a percentage of total bank credit in India, it's quite low. And if you look at the experience of countries in other parts of the world, what we gradually see over a period of time is that the share of credit in the hands of retail actually tends to become a larger and larger share of bank credit or non-bank credit, and actually a lot of the corporate borrowing gets disintermediated into the bond market. I think this one trend has been very, very powerful for a lot of Indian institutions, whether they be banks or whether they be NBFCs. they've really benefited from the growth of retail lending. Certainly there has also been an argument to be made that they have gained market share, because some parts of the banking system have been in capital preservation mode, they've been risk averse, they've had a problem of corporate sector NPAs, and therefore some of these people have also gained market share. Some of this pace may slow down because we are seeing the recapitalization of the PSU banks in particular. Also some of the troubled private sector corporate focused lenders have raised money to absorb the pressure from NPAs. So we could see a little bit of a market share shift, but I think it has got an underlying trend which is powerful. And therefore we do find value in some of these financials, both either because they can grow, or alternatively in some cases we think that these companies are on the cusp of a turnaround in their credit provisioning in their profit and loss account. It's been very heavy over the last few years, but we think there will be a normalization of credit costs in the P&L account for some of these corporate sector or focused lenders, or even some asset financiers, and that could actually give them a leg up over the next few years.
Vetri, it's uncanny as I read your list of favorite books. It's a book that Nikunj talks about every day and pushes me to read this one, Against the Odds, The Remarkable Story of Risk by Bernstein. Tell me, what's been your learning from the book?
Sorry, could you repeat that?
No, I was just talking about your favorite book. That's Against the Odds, The Remarkable Story of Risk. What's been your learning from the book?
Well, I think the learning from the book is very simple, that we don't completely sort of take cognizance of risk in the way that we should. We misunderstand risk, we misprice risk, and eventually that is the cause of a lot of grief. And therefore, if you can handle risk, and actually the interesting thing when you read Peter Bernstein's book as well as his interviews and comments is that he always talks about risk as not just in the context of what we understand it, which is downside risk, but equally in the context of what he calls upside risk. And I think it's a very interesting way to look at risk, and not merely look at it as something which requires protection from, but also that some level of risk is desirable, because that is what actually creates the upside as well. So I think his sort of the way he looks at risk is very different from the classic interpretation of risk, which is simply that you either be defensive or you look to buy protection against risk. Risk is actually at two ends of the spectrum, and you need to sort of figure out how you will position yourself to benefit both from upside risk and downside risk, and which is where again I find his thought process on diversification very interesting, because he actually talks about the fact, and he's always said this, the future is unknown, the future is hard to predict. So the sort of logical conclusion from that is you don't know where the upside risk might come from, and therefore when you diversify, it's not just to protect yourself from downside risk, but it's an actual explicit acceptance of your ignorance, and therefore also a positioning which will hopefully allow you to diversify your portfolio in a way that it will allow you to capture upside as well. So it's a very different thought process that he brings to the table in terms of the understanding of risk and diversification, which is typically seen as being defensive, but that's not how he positions it.
Fantastic to have you on ET now, and thank you very much for participating in this monthly feature of ours, AMC of the Month.